So today what we're going to be talking about is guaranteed future insurability.
Not every policy has guaranteed future insurability option.
And we just please don't die in the meantime.
Hopefully they're adequately covered when they started.
Yes, that's right, yeah.
The pros or the advantages of it are that there's a number of things. Number one, you don't need to go through medical underwriting to increase the cover.
And I think people watching this will realize, well, I've had a baby or I've had a pay rise, like all of these life events we've had since we've set up the policy, and may not have known that they had these features available. Hey there, Phil Thompson here, and today we have another deep dive episode with one of our most experienced advisors, Eddie Scalpelli. Thanks for joining me, Eddie.
Thank you. Thanks for having me.
So today what we're going to be talking about is guaranteed future insurability. So
Correct.
we're going to be talking about what it is, what are the different terms, how does it work, when to use it. And so it's going to be deep dive in that. And, a lot of the work you do at Skye is reviewing policies and
Correct.
having conversations with existing policyholders, existing clients, when they've got a new mortgage or had a baby or want to look at decreasing cover. So we thought it'd be perfect for you to have a chat about it.
Thanks for having me.
So first of all, what is it? What is guaranteed future insurability?
Yep. So guaranteed future insurability is simply a mechanism or a feature in a particular product or in an insurance contract that allows you to increase your cover subject to certain triggers within your circumstances without having to go through full medical underwriting.
Yes, and which is important because if you've had health events in between when you took out the cover and increases, we can actually not hide them, but use features in the policy to increase the cover.
That's right.
As well. All right, so what are the different names? So each insurance company, we love using different names for everything. Like trauma insurance has got like 15 different names, it feels like. So what are the different names for future insurability?
Yeah, so obviously with the amount of insurers on the market today, they all like to use their own terminology just to confuse us. But there are a number of different names that can be used. Generally, the ones that we see more often are guaranteed future insurability, future insurability option, another one called life increase benefit, and then future increase benefit.
And so internally as a business, we like to refer it as guaranteed future insurability. We try not to use acronyms, but in this case, sometimes we do. So we call it GFI. So that's our term, but we're going to talk about it broadly, reference that even if a different insurer uses a different term because we've got clients across all insurers.
We do.
All right. So is this feature and benefit the same across all insurance providers?
Not necessarily. So most of them will cover the general things, which will be marriage, having a child, taking on more debt or changes in salary. But it is pretty important to work out which contract you've got because every insurer might have something different in there. We're pretty much across most of them based on the current contracts on the market. But essentially, if you have a very old contract, it could be something completely different.
Yeah, it's different across insurers, which makes it harder. But even the same insurer, if you took out the policy 5 years ago or 10 years ago, may have a different feature and benefits. And so they adjust it over time as well. So that's what makes our job fun and interesting is having all these complexities. Mm-hmm. So let's just talk broadly about what are the broad advantages and disadvantages with guaranteed future increase.
Yep, so guaranteed future increase basically means increasing your cover based on certain events. The pros or the advantages of it are that there's a number of things. Number one, you don't need to go through medical underwriting to increase the cover. It's a faster process. You don't need to go through a full application form. There's no medical underwriting or medical tests that'll be requested. It's guaranteed approval. It covers milestones, as I said, marriage. I think some even covered divorce.
Yep.
Having a baby, salary increase, minimal paperwork, which we can help you with. But the major thing is that by being able to increase the cover up to certain limits, which we'll go through, essentially you're kind of factoring in that you're not going to be getting any declines, any exclusions or any loadings on those policies because you're keeping within those limits and you're kind of exercising that option within the limits that they allow you to do.
Yeah, which, we will talk about some of the cons and actually some examples of it. So it sounds amazing. Sounds too good to be true. I'm getting an increase without having any medical disclosures. So let's talk about what are the cons.
Some of the disadvantages are there are very strict timeframes. So you need to do it generally within a renewal period of you getting your renewal, or within a particular number of days of the trigger event occurring.
Yeah.
The other thing to consider is that there's caps on how much you can cover yourself. Generally for life cover, permanent disability and trauma cover, the cap sits at 20 to 25% of the original sum insured that you took out when you took out the policy. For income protection, it could be 10 to 15% of the salary that was taken out under the insured monthly benefit.
Yeah, that's right. And so when we talk about like original sums insured, so if you take out $1 million and you hold that policy over 5 years and it increases slightly, you may, have $1.2 million in 5 years' time, let's say. And then when you go and exercise that increase, it's going to be based off that $1 million, not the 1.2 million. Because some will have caps on like hard dollar caps, like 200,000 or 25%, whichever is lower. But yeah, it's based on that original sums insured, which is interesting because we did a lot of advice for young clients who didn't have a need for life insurance cover, and we historically didn't recommend much. We recommended a little bit to match it with trauma. Overall, it was cheaper. But if it was cheaper not to have much life insurance, well, we didn't have much life insurance. Now we've actually moved our philosophy with this in mind, whereby if a client needs $1 million of TBD, but only, no life insurance or a small amount, we'll still recommend $1 million of life insurance because generally it's cheaper anyway, number one. Number two, if their life situation changes where they, have a requirement for life insurance, they've already got it. And the third thing, which is super important, is it's based on the original sums insured. So if we had $100,000 of life cover and then we increase to $800,000 later and then try to exercise, well, it'd be 20% of $100,000. And so, these features is impacting our advice for new clients today, even though this is predominantly, a great episode for existing clients to listen to, but even new clients who are thinking about what are these features and benefits in the future that we may use. It's a good deep dive for everyone to listen to.
Yeah, and look, I can say that having done reviews already or going through this review process, most of the clients that I'm seeing are more around the income protection, not so much the lump sum, where clients are just saying, look, I know I can increase my income by $5,000 per month, but at this stage I'll just go that 2.5 that I can do without having to go through underwriting.
And it's just easy as well. Like having to go through applications. All of our clients have gone through an application before and they're painful, annoying, time consuming. If I can just fill out a quick few forms and, and meet some requirements, which we will talk about, I can just increase that. And then in a few years' time when I can exercise it again, well, let's do that again. Right. So what are some other disadvantages?
Well, we spoke about the limits. So as you said, it's usually percentage-based or a number-based. You can't be on claim.
Yep.
That's one of the things. Depending on the insurer, they won't allow the increase if there's any loadings or exclusions on your policy. So the only thing we can recommend there is that if someone is looking over their policy, they want to try and exercise this, to come back to us, let us know. We're happy to check the policy terms and then come back and say, look, even though you have this exclusion, this particular insurer actually allows you to do it. While there will be others that don't let you do it.
And so the question I have is, if I'm a client and have a policy with the one that doesn't allow me to exercise it with the exclusion, and I've got an exclusion, why didn't I go with the other insurer at the time?
When you took out the original policy?
When we recommended the original policy. And the answer I have is there are so many factors when it comes to deciding the original insurer. So maybe the other insurer who would allow it with an exclusion, maybe they were going to put 2 exclusions on the policy. So, any client who does have these questions, the original documentation we provide has got all the expected terms from every insurer and all of these things. And this feature, albeit incredibly important, and we put a lot of weight on it, isn't the most important thing. Like removing an exclusion that's, pre-existing health getting cover that doesn't include a pre-existing health condition versus one that does is much more heavily weighted in our recommendations.
Agree.
So talk to me about some of the key rules. Like let's dive a bit deeper in terms of like what are the key rules of these policies?
Key rules. Not every policy has guaranteed future insurability option. So most of them do, others don't. So again, we can check that if it's on your policy. We had a quick chat about no exclusions or no loadings on that policy. Usually there is a time frame of 30 to 60 days that you can actually exercise these. Now some you can do it at renewal of the policy, others you can do it when it triggers the event that it's occurred to yourself. So taking out the new mortgage, you have a specific time frame to be able to come back and say, okay, I now want to increase it.
And some of the old policies had like any time after that event, you could exercise it. But these days, the policies, because these features they're good in some ways and bad from an insurer's point of view. When you have an insurance contract, you've got to go, what's good for the insurance company and what's good for me as a policyholder? And me as a policyholder wants the best for the insurer as well, because we're all policyholder. If you claim unjustly on your policy and we're with the same insurer, I'm going to pay for it because my premiums go up. So there's always this balancing act. So the good thing about these features is if I've had a health event, I can still increase my cover. From an insurer's point of view, well, that's not good because I'm offering you more cover for something that's, and including something that's more likely to be claimed on. And so there is this kind of push and pull when it comes to the insurers is accessing these features. So some of the old policies have sometimes a little bit more generous, at time of execution. But these days, it can be like literally within 30 days before or after. Some insurers are 30 days before after the event. So there is can be strict rules, which, talking about the process, like what do we actually need to do to action one of these increases from our end?
What do we need to do?
Yeah, like in terms of going to the insurer, getting a quote, because we've got to work out what the cost of that increase is.
Yeah, so I'll go back to the reviews that I've been doing. We had one client coming in who wanted to increase his income. He actually did qualify for the Guaranteed Future Insurability benefit. We went off to the insurer, got a quote to the maximum that he could get, and he was actually short $293 per month to what he wanted to go up to. And it was a case of, here's your two options. You can either go Guaranteed Future Insurability, you're going to be short or underinsured by $293 a month.
Yeah.
No questions asked, you can just increase that cover. There's no medical underwriting. But if you really want that extra $293 a month, you're going to have to go through the whole process. Yeah. And we got a pretty quick email back saying, I'll just exercise.
Yeah, give me that form. Yeah. Give me that one pager. I'll fill that in. Yeah. Yep. And this is where I guess a bit of my point is giving us time. Like if it is a 30-day window, well, knowing as early as possible, because some insurers these days are getting better at allowing us to do adjustment quotes on their portal. A lot of them are still a bit tricky to be able to do it. So we've still got to email the insurance companies. Now, it sounds archaic, like, anyone who's got car insurance or home and contents insurance, it's all online, like health insurance, it's all super easy. Life insurance, it still feels like they're working on like MS-DOS these days.
Yeah.
And so it takes us time to action those quotes and actually get those options and then put them in front of the client. And so as early as clients have these life events, it's important that they reach out and get in touch.
Yeah. And look, we've had a couple come through where they genuinely want to increase their cover, and we've had a look at the Guaranteed Future Insurability benefit, and it's like, well, if you wait 4 weeks, you can actually go through the Guaranteed Future Insurability option and you don't need to go through underwriting again. Yeah. So again, we'll give them both the options, and most of them are saying, well, if it's an extra 3 or 4 weeks before that actually kicks in because of renewal, then that's what I'll use.
And that's, and we just like, please don't die in the meantime.
Hopefully they're adequately covered when they started.
Yes, that's right, yeah. All right, so let's talk about some examples. So we conceptually understand it can increase by 200K or 20% or whatever it is. Like, give me an example exactly. We've talked some of them, but give me a bit more.
So we've got a client who applied for insurance with a particular insurer back in 2023, got married in June 2025. Original life and permanent disability cover was $1 million, and trauma cover was $150,000. With CPI over the last 2 years, his income, his life insurance and permanent disability cover is now sitting at 1.2, and his trauma cover is sitting at $167,000. So technically, he can exercise the Guaranteed Future Insurability benefit. Again, it would be a very simple form. We get the quotes. If he's happy with it, based on this insurer's product disclosure statement, he can increase that cover by 25% of his original benefit, or $200,000, whichever is the lesser.
Yeah. So go back. Let's talk about some insurance. $1 million, 25% is $250,000.
Yep.
Or $200,000, whichever is lesser.
Correct. So it would be the $200,000.
Yeah, we were capped at $200K.
Yep. Technically, he can increase his life and permanent disability cover to $1.2 million. The original trauma commenced at $150,000, 25% of that he can cover. So that ends up being $37,500. So he can increase his trauma benefit by $37,500.
Yeah.
Now, they may not be huge amounts, but if you're securing it against the original terms that you got, which might be standard rates, then there's no kind of effect on that policy.
And some clients, like I know as a part of the review process, sometimes we will, if a client says, no, I don't want $200K extra, I want $1 million or I want $500,000. Okay, great. Well, what we can do is let's execute this option.
Exactly.
We don't go through any underwriting, and then the extra $300,000, because if we do get an exclusion on future applications, it'll be based on that increased amount. And so, so we can get only $300,000 with a new exclusion as opposed to $500,000 with an extra exclusion. So we can actually do both. Like, so even that client who was underinsured by $200 and something, like, it's probably not worth it for them to do that. And if it is, great, we'll help them go through that. But people recognise that it's probably not worth the pain to do that smaller increase. But if they wanted to and that client chose to, great, well, let's do the guaranteed future increase amount. Easy, but then that extra amount. And it also means we get you insured quicker. So we're at least the insurance company's on risk for that full amount sooner than they otherwise would be, and it may take 4 weeks to go through an application.
Yep. And on that point, we had a very similar case where a client, his income had gone up quite a fair bit and could basically increase his income protection by $5,000 per month.
Yeah.
And we went off with the original application saying, let's go for the $5,000. And then the reviews team came back and said, look, we can actually use guaranteed future insurability for about 2.5 of it. Yeah. So we did that, and then he only got assessed on the additional amount.
Yeah, perfect. And so when's a good time? Like if people are watching this and they're going, oh, didn't even know this existed, number one, which, most advisors don't know it exists. So it's no surprise that clients don't know that it exists. When is a good time to action some of these and execute it?
So the first thing I would say is always check your policy documents. And make sure all your product disclosure statement, which we send to you when you take out a policy, just to see if the feature's in there.
And a hot tip, Control F or Command F, depending on if you're PC or Mac, search one of these terms, future,
increased benefit, guaranteed future insurability, and there was a couple more.
Or just send us an email and say, well, tell me the term for
this particular
insurer.
Yeah,
and then we'll let you know what it is. Yeah.
So that would be the first thing. At least you've got it, because as I said, not every insurer has it. Trigger events. If you know you're increasing your mortgage and you've got this feature on your policy, feel free to reach out. At renewal, there's usually a period of time that you can address or access the guaranteed future insurability option.
So sometimes it's like within a certain number of days of the event or at your next renewal.
Yep. So if that's the case, have a look. Feel free to book in an appointment with us. We're happy to go through it. We're happy to see if you need more or less. We can then go away, request the quote, but in the meantime, our review team can have a look at the product disclosure statement, see what the limits are. We can request quotes just for the guaranteed future insurability, or we can request the guaranteed future insurability and the additional amount. And then we will come back to you and say, hey, these are the options you've got. You simply say, I'm happy with it, and then we move forward.
Yeah. And that's the, one thing to note is that, if you're increasing your cover, your cost is going up. So everyone wants to know what is the cost. So we can go through that process and go, Eddie, it'd be great if I can get a quote to see what the cost will be if I execute this. And then it comes back and you go, clients may go, good to know, but maybe I won't execute it. And sometimes it can be a conversation of, if it's something like an income increase, do you expect your pay to rise by a certain percentage? Do you think you'll meet this requirement in the next few years to action it? And if you don't, but the premiums are comfortable enough, maybe you may as well just execute it now. And that's the conversations that's worth having with an advisor to talk about the pros and cons. Because if you're triggering it on a birth of a child, well, if it's your last kid that you're having, then you may want to execute it then. But if you're planning on having another 3 in the next 3 years, like a crazy person like me and my wife, then we'll trigger it the next kid. That's fine. And so is there anything else that we haven't touched on, or is there anything really important that we want to communicate?
Yeah, so there was one thing that just came to mind as you were talking about taking out these particular options with guaranteed future insurability. Some insurers do have a limit on how many you can do over the life of that policy. It could be 5, it could be 6, it could be 3. There are insurers that allow you to keep doing them depending on how nice they want to be. So that might be another option to check. Obviously, if people are doing it to build that safety net with their income protection, saying I've had an increase, so I'll use this feature every year, you may get to a point where you're not going to be able to do it again. Not just for the income protection, but for the other policies as well that you hold.
And this is why I think the insurers do factor and peg it the increase against the original sums insured. So like if you go and one insurer says, I'll let you increase life insurance by 20% of the original sums insured, or a maximum of $200,000, and you've got $1 million policy, the max you'll get without underwriting is $1.6 million annually. Or sorry, without additional underwriting is that $600,000. So whether you execute it like in the next 3 years or whatever, or year 10, year 20, year 30, the max that they'll offer is still at that cap amount. And it's important to note, because it's not a reason why we would recommend one insurer over the other. It's very rarely going to be, this insurer allows you to execute it 10 times and this only 3 times. Like there's many other reasons why we would choose one insurer over another, and this is kind of far down the list, albeit super important. But yeah, that's a good call out. It's not just you just keep going around, 25 times over the next 30 years. Awesome. Well, this has been super informative, and I think we'll get a lot of people actually reaching out to get in touch, because this is probably something that as a business we can do better at communicating. There's 150-page PDFs. We can't communicate every feature and benefit. Like there's, hospital benefits and all of these benefits inbuilt in policies that we only have an hour to go through the recommendation. Most people care about what's the cost and what's the level of cover and what are the terms. And so it's important for us to know that. But I do think we'll get people reaching out and getting in contact. So maybe just talk through what the process looks like when people want to review their cover.
So the process is you'll more than likely speak to me.
Yeah.
Follow the link on the Skye website for a review.
Yep.
Put in just some basic details as to what you'd like to discuss. You can then pick a time in my calendar to book in a call. They usually go for about 20 minutes. It's a very quick recap of what you have. I do like to touch on, because I don't expect people to remember their terms and level and step premiums 5 or 6 years ago. So it's a quick overview of what you've currently got, what's your current circumstances, what would you like to change. We'll then send the client an email. There will be a link for them to complete, just with some basic details and what they would like to look at. When that comes back to us, the teams will then match that up with my file notes, make sure that it all matches up, go off to the insurer, request the quotes. When they come back to us, you'll get an email from us saying this is what you wanted to look at. And then any paperwork that needs to be completed. Yeah,
and there's really there is 2 options off the back of that review call. One is, hey, we want full financial advice again. Like we want to go through a full review, which is good to get the advice. There is an option for clients to say, actually, Eddie, after our phone call, I just want to tell you I want to increase it by this amount of money. However it gets executed, whether it's this guaranteed future increase or whether it's underwriting, whatever, I just want to tell you I need an extra $500,000 or $200,000. And so we give that option. So one is much more broad up, a full review, providing financial advice, and the other is, we will help transact and execute that transaction, because, the way the world is with insurance, you can't go to the insurer and increase it directly. Like there's a lot of limitations there. So, all right, Eddie, this has been a great chat. I think it's important, and I think people watching this will realize, well, I've had a baby or I've had a pay rise, like all of these life events we've had since we set up the policy, and may not have known that they had these features available. So maybe just talk broadly about how to those clients reach out and get in touch, but also broadly about our review process and how it all works.
So at any point, you can book in a call through our website. It'll be allocated to one of our advisors to be able to give you a call. You book in a time into one of our calendars. We will then give you a call and discuss it in more detail. We may look at just the Guaranteed Future Insurability benefit at that point, but our reviews in general will be that we'll have a look at what you've currently got in place, whether there's any exclusions or loadings, whether there's anything that can be reviewed in terms of those exclusions or loadings.
Yep.
And if there's been significant changes in your circumstances, like babies, increasing debt, new jobs with higher incomes, then it might be a case of looking at a potential full review and having a look at what sort of cover you need to have in place at that point.
Yeah, and one of the things off those calls, like you'll obviously talk about what they've got and what their policies are at the moment, because as we talked about, policies may start at $1 million and then increase to 1.2 over a few years because of indexation. So yeah, it's important in those calls you'll talk about what cover do they have.
Yep.
We love insurance. We think about insurance all day, every day, but people don't open up their policies schedules every single year, so they may forget exactly what they've got or what the need for it was. Like, why did we actually go to 1.2 mil? And I had a call the other day. A client was saying, "Oh, we've gotten a mortgage. I can't remember if we got the mortgage after we set up the policies or before." And so, I looked at the original documents and I'm like, "Oh yeah, we built that mortgage in. This is what we assumed, and whether it was before or we just built it in." Well, I don't know. But yeah, so just recapping on that. But then, yeah, you talk about there's kind of a few options off the back of that phone call. So talk to me about those different options.
Yep. So if we can utilise Guaranteed Future Insurability up to a point, we will. For some clients, it'll be a case of, look, I've taken on $500,000 of new debt. This is all I want to cover. So we can do that as well. And then obviously there might be the full review of their circumstances.
Yeah.
The one thing I'm noticing with a lot of review clients at the moment is they don't quite remember what everything means. And for them, it's more of I just want to touch base to understand what I've got. And that's fine as well.
Yeah, which is great.
Because we don't expect people to remember what they had 6 or 7 years ago.
Yeah.
Terminology's changed in terms of even premiums nowadays. So
some insurance companies have changed. My insurance policy used to be by a blue company, now it's a green company. Even though the policies are all exactly as is, insurers do change as well.
Yep. So we'd like to think that we're here to provide that review service, just to give some peace of mind, and just make sure that the cover's still appropriate. Because there are points where you kind of say, well, you're now at a point where you don't need as much cover. You might want to start to reduce it. Or your circumstances have completely changed. You're in a financial position now that you don't actually need some of these insurances.
Yeah, and there's a few kind of options. So we provide a full financial advice, which you were talking about that review, which is us giving advice on this is what you should increase or decrease. And these are, maybe we move insurance providers for these reasons. The other one is, we will just help people adjust their cover as requested. So, at the end of the day, people may just say, I just want an extra $500,000 because that's what our mortgage is, and I'm happy to not go through the advice process and just increase the cover or decrease the cover. And so we'll go off their instructions and prepare, do all the paperwork and get everything ready for that. Or clients may just, as you said, just call up, have a call, go, just tell me, understand, what is critical illness again? Like, what is it? How does that work? How does it pay out? And then there's no actual changes off the back of it. So there is no requirement for them to make any changes and no requirements for us to make any changes as well. All right. Well, thank you very much for your time. That was a great episode. Probably, to be fair, one of my favourites so far. And don't tell any of the other advisors that this is probably one of my favourite deep dives.
That's right. I'll keep it hush.
But that said, if you do want to watch one of those others that aren't as good as this, they're on the screen right now. As I said, Eddie, this is one of my favourites. Thank you very much.
Thanks, Phil. Thanks for having me.